Today is Friday, August 16, 2024. We are just past the halfway mark for the month of August, and it's time for the Million Portfolio Review. So as of market close today, the portfolio made an all-time high. It's sitting at 1.199, so we're almost to that $1.2 million mark, which is great. I'll go into some of the performance details in just a bit because we are actually closing into the 3-year mark for this portfolio, believe it or not. Next month would be 3 years since I started making this public and working with this particular allocation with some minor tweaks along the way. But like I said, I'll talk about that in just a bit. Let's go ahead and take a look at the portfolio itself and the allocation. So from last month, the allocation has changed just so slightly because the long-term treasuries have just gone up ridiculous. So if you take a look at TMF, which is my triple leverage treasury, it's now almost 50% of the account by itself. TLT is almost back in the green, and then the rest is spread out among the other assets, which is the NASDAQ 100. This is the QQQ, the triple NASDAQ 100, the TQQQ. We have some gold, and we have some value stock in the form of a REIT, O, and the Schwab Dividend ETF. So if you recall, what I intended to do for this allocation in 2024 was essentially to keep the allocation the same, except to introduce some leverage ETFs into the growth stock allocation and the long duration bond allocation. My thinking there, just to recap, was that stocks are very pricey right now, especially the high cap growth, that Magnificent Seven. And there's some thinking that perhaps in the next 5 to 10 years, we're going to have returns that are below the average. Because there is this concept of reverting to the mean, right? Where over the long term, things are supposed to get back to their average. So if we've been running hot for a while, it means that we have to run a little cooler to make up to that average. And no one really knows what's going to happen in the long run with anything market related. So all of this is a guess, but it's as good a theory as any, and I think it has some merit. So I don't mind taking a little bit of my allocation to large cap growth and introducing a bit of leverage. If that was to come true, then my hope is that this would allow the overall portfolio to kind of keep pace with historical average. So that's the first reason. On the long duration bond, I did not mind adding leverage because it took a while. I mean, the first rate cut for 2024 is not even going to be till next month. But it looks like inflation is very much under control. There's concerns about the labor market and that the economy may be on shakier ground than it first appeared. But regardless of that second part of the Fed's mandate, they're going to cut rates in September. I think if they did not, it would be a shocker. The only question really is it going to be 25 basis points or 50 basis points? If you recall that when we came into the year, people were thinking there may be up to 6 rate cuts. I think now that's not happening. We're going to see 1 to 3 rate cuts. I think most people think that it's 3, and then we'll see what happens, with this first one in September. I went into long duration bonds way too early in 2024. I didn't necessarily believe that we were going to get 6 rate cuts. I did strongly believe that if inflation is coming down, and there were signs of it all through the year, even if it was rocky, that the rates that the Fed has the federal funds rate at right now is way too high. They want to have a neutral policy stance, and the rate that they have right now is a very restrictive stance given where inflation is. So I knew they were going to reduce rates. The question really was when. And part of that problem is that if you move in too early and rates are not being reduced as quick, the market can overreact and your bond can drop in price pretty quickly. And that's what happened to me. So my long-term bond, the TLT, was down pretty substantially, before we got to August. But there came a point, I don't remember exactly when, maybe it was back in June or July, where I said, you know what, this is ridiculous. We're going to see a rate increase. We're going to see a rate cut. And if that's going to happen, and as we were moving along in the year, and gets more likely, where you want to be is long-term bonds. And at that time, TMF, the triple leverage long duration bonds, was just really, really low. And I said, forget it. I'm just going to take the cash that was sitting in the account and just buy all TMF and let the chips fall where they may. And that's why we end up with almost 50% to long-term bonds in the triple leverage today. We have 11.6% of just the regular long-term bonds, but a large part of it is triple leveraged. So what I'm going to do now is I'm going to sit on this allocation through the end of 2024 and into the early months of 2025. I do rebalance early in the year in 2025. That's my annual plan. And at that point, I will bring everything back to the 2024 allocation. I'm going to take advantage of the 3 rate cuts we're going to see in 2024 and see what happens with the first 2 months of 25. And we'll kind of take it from there. There may be recessions coming around the corner. No one knows, right? Every day someone's predicting some doom and gloom or another. But my other reasoning is that if there were a recession at 5.25% to 5.5% Fed funds rate, where we are today, there's plenty of room for the Fed to act and can cut more quickly. And if that does happen, I'm going to benefit with my long-term bonds. So in other words, I'm not in a hurry to change this, even though it's completely out of whack from what I had planned. But one of my other resolution for 2024 was that once I buy something, I'm not going to sell it until I rebalance. And that's pretty much holding true. And it's getting more out of whack as the long-term bonds are going up. Am I particularly worried? I don't think so. But it is what it is. Let's talk about performance, because I mentioned that at the beginning, and I'm just getting back into that. So I'm going to put up a couple of charts here. Over the last almost 3 years that I made this portfolio public, for the most part, the portfolio was tracking the S&P 500. That was until about 2023 after the rate hike, where the long-term bond just really killed everything. And you can really see it. There's this separation, starting in 2023, going even through this year. But when you look at the long-term trend, I'm definitely higher than where I was when I made this portfolio public back in September of 21. And we're almost back to where the S&P 500 is. So even though we're lower today, there was a week in August, when the global markets and everything else was dropping ridiculous, that my portfolio was actually outperforming the S&P 500 over that 3-year time frame. Right now, I'm still a little bit below it, but it's definitely moving in the right direction. And I'm actually pretty happy with this allocation. The point in talking about this performance is that in the short term, and 3 years is a very short term, even though it doesn't seem like it, you can see negative returns or almost flat returns for that period of time, if not more. There was like that lost decade in the NASDAQ after the tech crash of 2000, 2001, where it was even much longer. So a 3-year kind of barely flat, or barely growing, I should say, but pretty much flat returns is not out of the ordinary. And if you look at the S&P 500, it was pretty much on the same track. This year was just gangbuster for the S&P 500, and that's why it pulled ahead. But it is not unusual to see these couple of years of overall just paltry, mediocre returns. But then you have events where you're just going to shoot up and go through the roof. And that's part of investing. If you can hang on for those gains, you're going to do well. And if you look at even my portfolio, it was getting the heck beat out of it for the last, call it 18 months. But in the last just month and a half, 2 months, it's really gone up crazy. If I pull up portfolio performance over the past 3 months compared to the S&P 500, I guarantee that my allocation is doing much better on a return basis. But those are all short time frame. So my point in discussing the performance over the last almost 3 years is that you're going to run into these rough patches. And if you can just hold on to what you have and ride it through, you're going to be fine. So that's where we are. We're at a new high for the portfolio. Still not where I want it to be, but I have every confidence that as we head into the end of 2024, things are going to be good. So anyways, thanks for following along, and I'll see you in the next update for the $1 Million Portfolio. Thanks for watching, and I'll catch you later. Bye.